It's a late night show, especially on the East Coast. I think it's like 1 o'clock in the morning on the East Coast. I think it's like yeah, it's about 10:30 here in Denver, Colorado. But this is when I had time. I said, let's just do this show. I didn't want to miss this show before the day ended. So if you are in here on the late night creep and episode here, y'all go ahead and hit that like button tell me you're checking in from. But ladies and gentlemen, y'all already saw Facebook stock jumps 25% today after reporting its earnings. Why is that? Let's take a look into that. Also, the Federal Reserve again raising interest rates. Why? Kind of came as a shock. But we're going to talk about that and more. We're going to listen to the Federal Reserve, why they're raising interest rates. What is their outlook? And we're going to look into Facebook as well and see what's going on. Facebook is in some of the portfolios that I manage, but some of them I kind of, as it was going down, I kind of got rid of them. But ladies and gentlemen, we're going to do that and more tonight. But y'all already know, if y'all haven't done so already, what time is it? Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it on this live late night show. It is Friday morning on the East Coast, and it's still Thursday morning winding down. I had a lot of things to study today, man. You know, I was in studying about private debt, private credit, learning all the nuances of that, how that works, and all of the good stuff like that. During my internship, writing up some things to make things better at the organization I'm interning with now. And yeah, kind of got a little late into the show today. You know, schedule's kind of busy. You know how those things go. Life catches you around. So, ladies and gentlemen, let's get into it. The first thing, y'all can tell me if you are catching this live. Please let me know if you can hear this. Let me take this off. Y'all let me know if y'all can hear this. Where we at? Where I want to be at? Where we at? I want to make sure y'all, I'm going to hit this play button. Tell me if y'all can hear. This is Jerome Powell yesterday. This is our Fed chair. He's going to give us some key insight to the market, all of the good stuff like that. So here we go. Let's go ahead and play him. Tell me if y'all can hear him now, okay? Here we go.
Good afternoon and welcome.
Can y'all hear that?
My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary
Oh, crap.
policy.
Here we go.
We've covered a lot of ground, and the full effects of our rapid tightening.
Can y'all hear the Federal Reserve Chair, Jerome Powell, Kitchens live?
We have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points.
25 basis points.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
Look at these economic developments.
The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated.
Unemployment.
Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
He's boring, but he's important.
In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward goals as we determine the extent.
Okay, that's the Fed chair, right? So you guys and girls who are here watching it live, DJ Dykes said, man, this guy is boring. Yeah, listen to the Fed chair talk is dry, but it's important, right? Why is it important? This is the guy that controls the price of money. He's the one that controls the price that we see on our car notes. Well, not our car. If you go buy a car, if you go buy a loan in the private equity market, the private debt market, the private credit market, lenders, what this guy says controls all of that. So is he boring? Is he the most entertaining? No. But is it as important? Yes, as an investor. Something I heard Warren Buffett say a long time ago. I was at one of his meetings in Berkshire. And he said, if I could have one piece of knowledge going into the future, it would be what is the future interest rates. So when I heard him say that, I always was kind of like, how does interest rates correlate to investing? How does investing correlates future interest rates correlate to investing? And once I started to study that, I understand why it's so important. Jack said, that's how it goes. Yeah, usually the most boring people, because guess what? So many people, we like flash, we like glitz, and we like glamour, and we don't get to the real stuff. So pretty much what he's saying, let's wrap it up. What he pretty much was saying, they raised interest rate. What was a little shocking? Inflation seems to be peaking. So I thought the Federal Reserve would probably try to ease back or slow down on interest rates. I was very shocked that they went ahead and raised interest rates anyway. That was a personal shock to me. But then again, when they've just made the notion that, hey, we want inflation to be at 2%. Right now, they're saying inflation is at, I want to say, what's the CPI? I think it was like 8 or 9 or something like that. Don't quote me on that. But I should have known that off the top of my head too. But they're saying, hey, we want this at 2%, way over 2%. This is why we're going to keep pushing these interest rates. So as interest rates go up, what does that mean as an investor? That means that housing, mortgages are becoming more expensive, which is passing on to the housing market. And also it means that the biggest thing he's saying, we're going to reduce our federal funds sheet, our balance sheet, I'm sorry. When they say they're going to reduce their balance sheets, that's a fancy word of we're going to take money out of the market. Let me see what Conley, I don't do this, whatever. Who is it? This is some bot named Conley, whatever. No, I don't do that. So here we go. Hey, so he said, do they want it to be 2% relative to the Fed funds rate or 2% versus a year ago? No, they want inflation to be 2%. They want inflation to be running. They want a running goal of 2% inflation. And ladies and gentlemen, our latest CPI report was at like 8-9%. The last one I read, I didn't really read the most recent one. But I know we're like at 8%, but I know we're kind of peaking. So people think we're peaking. So he's like, hey, even though we're peaked, that's fine. If we're peaking at 8 or 9%, but still I want it down. So we're going to keep raising interest rates till it goes down. And we know that this is when we see these massive layoffs, this is a direct reflection of that. Because guess what? As they raise interest rates, two things happen. It affects I'm sorry, I didn't read that right. Year over year. You're right. 2% year over year. Y. You're right. I read that wrong. I thought you said a year ago. Yeah. They wanted 2% year over year. So here's another thing. As they continue to raise the interest rate, that raises the value of the dollar. It's pretty much pulling money out of the economy. When you raise the power of the dollar, it makes our goods more expensive to be sold overseas. So when you have a strong dollar, you weaken export, because if somebody's in Spain, it takes more euros to purchase things in America. And if it takes more euros, people buy less. So right now, as the interest rates are going up, it's sucking money out of the economy, essentially, and it's making the dollar more powerful, which in return makes our goods more expensive overseas. Once our goods are more expensive overseas, people buy less. There we go to our GDP. Also, money becomes more expensive to borrow. Companies are less likely to want to borrow money when interest rates are high. When companies don't borrow money because the interest rates are high, guess what in return starts to happen? They slow down on expansion. Then companies start to participate in, hey, let's slow down on expansion. Let's freeze off on hiring. Better yet, let's start laying off. When you start to freeze on hiring, you start to lay off, then you're talking about people are buying less things into the economy. Right now, people are talking about this upcoming recession. The recession has already been here, ladies and gentlemen. We just changed the definition. We already had that conversation. I want to beat that dead horse. But the reason why people don't, the reason we're in the situation we're in now with the Federal Reserve and how they're raising interest rates and how it's going to pass on to the unemployment numbers. Because right now you just heard him saying in his brief, the unemployment numbers are so good. The unemployment numbers look so great, right? Because unemployment is low. But do you think unemployment is going to remain low like that? So it was a shocking move. It was a shocking move to me to see the Federal Reserve still raise interest rates. But when they say we want it to be 2% year over year, that's their running goal. They want inflation to move at 2%. They think that's a healthy rate. And they seem like they're going to keep raising interest rates. So we're going to be in double-digit interest rates, which is pretty shocking. And if you go back and you do your history before I was born and before a lot of you guys and girls was born, Look at Paul Volcker. What did they do in the late 70s when they had out of control interest rates? Now, I'm sorry, out of control gas prices and inflation, and they used interest rates. Interest rates all up to 20%, I think it was 16 to 20%, and put them into a recession. Well, now the definition is so convoluted, we don't know what we're going to be put into. So let's go. Ladies and gentlemen, let's get into it. We just seen Facebook jump 25% today. And even though it did jump 25%, let's stop the malarkey about, oh, it's a great company now. No, Facebook still is not at the level it was before. So let's say DJ Dax says, who come up with the 2% matrix? Do you think it makes sense? That's them. That's the Fed chair. The Fed chair came up with, we think 2% is the goal. We think the 2% is a good running rate. That's what they're aiming for. Do I think 2% makes sense? Because you want a little inflation. You don't want a lot of inflation. You know what? Get back to me. Let me think about that one. That's a very good question. Who make it, does 2% really make sense? That's what the federal goal. That's what the Fed chair decided they want inflation to run at. That's what they're going off of. And that's why we get these interest rates keep running. So that's a good question. Is 2% really a good number to aim for? And why 2%? So let's switch gears here. Let's go to Facebook. Facebook, it's an ad revenue-based company. February 1st, they took a big hit last year in their ad revenue. So it wasn't looking too pretty last year. Let me make sure I'm still showing up here. There we go. So here we go. Let's take a look at Facebook. This is their 10Q. This is Meta. This is their 10Q. Yeah, they didn't put out the annual yet. This is not their 10K. I was just making sure I wasn't misquoting. Okay, yeah. So this Meta reports full quarter 2022. I'm sorry, y'all. That might be the 10. I don't want to make sure I'm telling y'all the right thing. This might be the 10K because it's giving a full year in it. Yeah, I think this is their 10K. 10K. So because it's giving a full year review. So here we go. February 1st, 2023. Meta. That's a new name for Facebook. It says, our community continues to grow, and I'm pleased with the strong encouragement across our apps. Facebook just reached a milestone of 2 billion daily users, says Mark Zuckerberg, Meta founder and CEO. This is on that conference call they had earlier today, but that is really dry. I don't want to listen to 2 hours of Facebook executives talk, but that's there as well. You can listen to it off of the investor relationship website, off of the Meta website. The progress we are making in our AI discovery engine and Reels are major drivers of this. Beyond this, our management theme for 2023 is year of efficiency, and we're focused on becoming stronger and more nimble organization. So Reels and AI seems to be big for them. You got to think about it. The thing about Reels that's different from Facebook posts, only your friends can really see your posts. A reel, anybody can see your reel. That's what made TikTok so popular. You get on a TikTok just because you have friends, you just don't see your friends' post. You can see anything on TikTok. That's what Reels started to do for Instagram and Facebook. So they took that from a TikTok standpoint. It was like, if you have a TikTok account, you log in, you just don't see what your friends are doing. You see what is everybody's doing on TikTok. So Facebook has taken that matrix and said, hey, if this person likes this, if they engage with this, we're going to increase your visibility. We're going to show you more engaging things. So they give you more visibility and they give you more what you like. So those reels that's popping up on your Facebook page that's talking about food, comedy, because they're using AI to feed you the information they think is more important to you. So reels have become very popular because they take away from you just being able to see just what your friends post. And that's what it does on Instagram and Facebook. And now that's what people are doing. YouTube is going to that too, shorts. That's why you guys see me put out a little bit more shorts than versus this long content. This long content, my live, is for that niche audience that likes to hear me get up here, talk, and go through finances. But today, what's popular is people love to get on YouTube and just swipe through shorts. People love to get on TikTok and just TikTok. People love to get on Instagram. They watch the reels more than they probably watch their own what comes down their timeline. Same thing with Facebook. So I'm glad to see that they are having some type of success with what they're doing. Also here, let's take a look at it, right? So we've seen a slight decline. This is in millions. So that's 32 billion what they made last year. 3 months. I'm sorry. Let's look at the year. So yeah, they made 116 billion last year, and they made 117 billion. So they did a 1% change. So that's a 1% decrease in the top line revenue last year. Also, last year, fourth quarter, they lost 4%. You can look at this top line. When I say top line, this is the revenue. So then you got the costs and expenses. You make a bunch of money. You still got to pay for stuff and all the good stuff like that. So you can see the income from operations is down from last year, 38%. So you're looking at 38% decrease from last year. In 2021, they made $46 billion. That's what they took on income from operations. And last year, they only made $28 billion. That's a 38% drop, right? Also, you see income from operations was down 49%. Not too impressed by that, right? Also, let's take a look here. Their net income decreased by 41%. Their net income, after they pay all your bills and all the taxes and all that stuff like that, 2021 was 39 billion. Last year, they reported 23 billion. That's down 41%. Also, 2021, you're talking about the quarter, they made $10 billion in the fourth quarter. Now you're looking at fourth quarter, they made only $4 billion, down 55%. So those ad revenue is drying up. So to me, personally, as I look at Facebook, when I look at those type of numbers, this is when I started to look at you as a peak. This is the thing that's crazy about life. Now, I had this conversation with a friend of mine earlier today, and I was saying the crazy thing about peaks and bubbles and troughs, you don't know what it is until it's gone. When I see numbers like this, when I see these top line revenue is on a growth company now starting to shed away 38%, 49%. I have to look at the rest of the industry because Facebook was a juggernaut. It was the first publicly traded social media platform. But now you got Pinterest and Snapchat and TikTok and Instagram. This is why cable TV is struggling. If you had $10,000, would you buy a Super Bowl ad for 5 seconds, or would you take it to social media? 9 times out of 10, you're going to take it to social media. It's a good thing Facebook brought Instagram, because had Facebook not brought Instagram, I think that would be the end, or Facebook would be down drastically. But one of the best investments, I think they brought it for $1 billion. That's probably one of the biggest and best investments. And WhatsApp too. So here we go. This is their DAP. This is their daily active users. That was 2.96 billion on average. So they had an increase in users. Daily users is up. Monthly active people, their MAP. This is the monthly active people, was up 4%. They're looking at their DAU, daily active users, is up 4%. So you're seeing the usage go up, but you're seeing right here, ad impression price ads. In the fourth quarter, ad impressions delivered across family apps increased 23% year over year. And the average price per ad decreased. The average price for ad decreased 22% year over year. For the first year, 2022, ad impressions increased 8% year over year, and the average price per ad decreased 16% year over year. Why is that? Why is ad prices decreasing? Is that because of competition? That's what it leads me to believe. And you know that Facebook is a ad-heavy company. So now you're looking at revenue. Revenue was 32 billion and 116 billion. I'm thinking that's talking about quarterly and annually. A decrease of 4% and 1% year over year for the fourth quarter, respectively. Okay. Had foreign exchange remained constant for the same period of 2021, revenue would have been 2 billion and 5.6 billion higher, an increase of 2%. Okay. So they're saying the ad revenue. This is just what I just got to telling you guys about. So they're talking about the foreign exchange rates had changed. So they're saying had foreign rates change had been the same, they would have increased 2% to 4%. Dingo. So that right there, ladies and gentlemen, is a gym. Where's my gym at? You're seeing directly in revenue how the foreign exchange, meaning the value of a dollar, how is it changing, how it would affect the bottom line of companies. So as we raise interest rates, the price of the dollar goes up, the value of the dollar goes up, quote unquote, because of what you call it. Because of, we're pulling money out of the market, the value of the dollar goes up as we raise interest rates. This is why we're listening to that boring guy like Jerome Powell, because you're seeing how it relates to Facebook. So when the dollar goes up and you're getting money from overseas, let's say if you're getting pesos, now you get less pesos. So when you was getting 100 pesos from Mexico, let's say if it was a 1-on-1, like Bahamas is 1-on-1 to America currently. So you got one Bahamian dollar, or whatever they call it, and you get one American dollar, same exchange. But let's say the dollar value goes up to $1.50 and you're still collecting that $1, you still got that same price. But when you do the conversion, you can see yourself losing 50 cents. Hopefully that makes sense. Y'all comment if that doesn't make sense. So they're saying, hey, because of the foreign exchange, which makes sense. So here they get down to the costs and expenses. Total costs and expenses increased 22 to 23% year over year. This includes charges related to reconstruction efforts. Okay. 4.2 billion in the fourth quarter respective. Okay. Capital expenditures included payments, finance leasings. Okay, cool. Shares repurchase. We repurchased 6.9 billion of the 29. I like when companies are purchasing their own shares. I think they look at that as they believe in their own company. As of December 31st, 2022, we had 10 billion available and authorized for repurchase. We announced today a $40 billion increase. So I like when companies are buying their own shares, because when companies are buying their own shares, they believe their shares are undervalued. So, and there's nothing like a company believing in its own thing. So I like to see share prices. You're taking shares off the market. You're giving more value to the shareholders. So a lot of companies do that. Instead of paying a dividend, they repurchase their own shares, which pushes up the prices of the stock. So cash, they got $40 billion in cash as of December 31st, 2022. Long-term debt of 9 point. That's pretty good. Pretty low debt. So they got $40 billion cash and long-term debt of 9.92 billion. That's not bad. It's pretty good. Finance is strong, because that means that in their cash, they can pay off their long-term debt. Very good. Head count was 86,000, an increase of 20%. Our reported head count sustained majority of, okay, these how many employees they got. Our reported head count and sustained majority of approximately 11,000 employees impacted by the layoff we announced in November, who will no longer be reflected on our head count by the end of Okay. So they're saying they got 86,000 was their head count in December, but they also laid off 11,000 employees. So they're saying by the end of the first quarter, you're going to see them becoming more nimble. They're restructuring. Okay. During the end of December 31st, 2022, we took several measures to pursue greater efficiency and to really realign our business and strategic priorities. This include facilities consolidation, strategies in subleasing, early terminate or abandon several office buildings under operational leases, and layoff of approximately 11,000 employees. A pivot towards the next generation of data center design, including cancellation of multiple data center projects at this summary. Okay, so they're laying off people. They're getting nimble. They're restructuring. That's another good thing. So they're getting nimble as well. Oh, 1 second. I'm going back to y'all comments. DJ Dex says, interesting. Never thought of that. I don't know what you're talking about right there. Tyler Snow says, bruh, relax. This is an educational vid. I don't know what you're talking about right there, Tyler Snow. But yeah, let's keep going. Y'all drop your comments. I'll definitely no gimmicks. Oh, who is I think I know who this is. Oh, he's telling okay, y'all talking to each other. My bad. All right, let's keep going here. So right there, they're getting very nimble. Okay. So you're looking at their cost of revenue. The cost of revenue, research and development, marketing, nothing too crazy to see there. So let's keep on going down. Let's see what we got here. All right. So my thing is, this is my concern with Facebook. As I go through their finances, right? This is their first thing. Oh, DJ X, you was talking to the. Oh yeah, okay. I think he's getting mixed up. So earlier in the show, we was showing the Federal Reserve talk. So I think he's looking at DJ Dax. Is that DJ Dax was talking about when the Federal Reserve was talking how it was very boring. So, and I guess Talon's coming and saying, "Hey man, this is an education video. No gimmicks or whatever." So, but yeah, he was talking about the Federal Reserve. So right here, ladies and gentlemen. This is my concern. You was talking about the foreign exchange. My bad. Yeah. This is why you tune into the investor show. You're always going to get a gem. You know that. You should know that by now. Yeah, Tom, we was letting the Federal Reserve talk. Everybody's like, man, this guy is boring as heck, So I was listening to the Federal Reserve. I played the Federal Reserve to go through why they raised that interest rate 2.5%. And we went through the whole thing. We talked about that foreign exchange. But you see how this machine is working. When the dollar gets strong, and that foreign exchange, I don't want to go into that whole lesson again, but when the dollar is strong, when you have a global company and they're taking in money, you're going to be taking in less money because the dollar is strong. And you can see that reflect onto your balance sheets, corporations, because people buy less. So the thing I'm looking at with Facebook, when I see what's happening with Facebook, I feel as though Facebook has peaked. You're looking at the revenue. I'm looking at the numbers. He said, reminds you of Robert. I think you meant to say Robert Kiyosaki. Yes, y'all know Robert Kiyosaki's been on the show before. Shout out to Robert Kiyosaki. Robert Kiyosaki, we had a little spat there, I guess. But no, he was a cool guy. But yeah. So anyway, when you're looking at this, I'm looking at that revenue. I think Facebook has gotten into that moment where it's peaking. And that now that it's peaking, that's the bad thing about being the king of the hill in tech. When you're the king of the hill in tech, now you pretty much just wait to fall off. Sorry to say, you die a slow death. That's the bad thing about getting to the king of the hill in tech. Now you start to fall off because now somebody like TikTok is going to come along, YouTube Shorts is going to come along and try to kill you. You just die a slow death once you get to the top. So what Facebook is doing is it jumped into Reels. It got Instagram into Reels. It got Reels to kind of follow behind TikTok. That's what Google has done to YouTube as well. So that's their way. They're kind of in that survival rating, and they're also becoming more nimble, which I do like. They're reconstructing themselves. But I don't know. I think Facebook best days are behind them. Nothing wrong. There's nothing wrong with it. I don't think it's exponential growth unless they can get into this whole metaverse thing and change something. But I think Facebook has peaked. That's my opinion. And this is going by looking at the finances, ladies and gentlemen. Look at the finances. Look at the revenue. It's more kids on the block. When Facebook very first came out at $20, something of his IPO back in 2012, and I remember walking with one of these chiefs. I can't remember his name. We was walking around the base, and he's brought about. I'm like, I don't know what is this thing called Facebook, but it got into the ad business, and it's just an ad revenue company. It's like the modern day newspaper, but it's now has kind of gotten to that peak. Okay, so he stated that debt should not be called debt; it should be called credit. Also, keep in mind that this show has a mass decrease in revenue. I like that. A mass decrease in revenue. Yeah. No, yeah, it is, you could call it debt, you could call it credit, whatever you want to call it, because it all depends on how you use it. Some people utilize debt as credit to buy other things. So what is happening, credit, debt, whatever you want to call it, is becoming more expensive. As the Federal Reserve keep hitting these interest rates, and they pretty much gave the sign, we want inflation to be at 2%. And when inflation is at 2%, they want inflation to be at 2%, and inflation now is like 8-9%. That's what they're reporting overall. So they're going to keep raising interest rates, and money is going to become more expensive to borrow, which will lessen companies' appetite to want to expand. Cheap Dykes. What's going on, man? So yeah, that's what I believe. I think Facebook is, y'all like my shirt, man? Me versus me. My microphone is kind of covering it. I like this, man. Shout out to Celos Clothing who gave me this shirt. Me versus me. Came over to the house the other day and sat down with me, and I thought this was a dope shirt. It's the only competition I got, me versus me. So yeah. So I look at Facebook. When you look at the ad revenue, you can tell that Facebook, it has peaked, and now they're scrambling. They're laying off employees. They're doing all these things to do anything. They're getting nimble. So by them getting nimble, this is increasing the value of their company. So yeah, that's what I got to say. So, ladies and gentlemen, as you saw, unfortunately, the Federal Reserve is going to keep raising interest rates. No sighting end of that, and they're going to keep reducing their balance sheet. They're going to be pulling money out of the market, and they're going to continue to raise their interest rates. That's not a happy sign for all our bulls out there, but I'm excited about this. I think we got about 1 year. 1 year of this, and we'll be out. Oh, I got to give it to my guy, Pete for Life, out there in Phoenix, Arizona. What's going on, Pete? Pete been holding down the show for years. This is a late night show. I want to say it's like 2 o'clock in the morning on the East Coast. It's like 11 o'clock at night here in Denver, Colorado. And I'm happy to see y'all in here anyway. But yeah, give y'all a quick summary. Federal Reserve is raising interest rates by 2.25%. And he said, get used to it. Hate it or love it. The interest rates are going up all year long because inflation is still running at 2%. And the job market is still healthy so far. So he's like, why stop? So he's like, hey, even though inflation looked like it has peaked, I still want to get it down. And he's going to keep running up interest rates. As he continues to run up interest rate, that's going to take the price of the dollar up overseas. So global companies, you're going to see it affect their bottom line, like you just saw in Facebook that we just read about. And that's kind of it, on that end right there. Also with Facebook, looking at Facebook, they shot up 25% because they're becoming nimble. When you look at Facebook top line revenue, you're seeing that revenue starting to decrease. And I just think it's new kids on the block. I think they was the biggest, baddest dog in town, and they ate up a lot of ad revenue. Now that whole ad revenue base that they survive off of has become more and more expensive, right? It's become more and more competitive. Now you got Facebook and Instagram. Now you got Snapchat run ads. You can run ads on YouTube. You can run ads on TikTok. And hey, the games is getting more expensive, So they're not the only dog in town. They're not the only game in town. They have high user engagement, but you're seeing the price of ads go down. So people like say he's working in Vegas. I've been thinking about going to Vegas this summer. So just taking my wife back to Vegas because the first time I took her to Vegas, she was pregnant. That's tell you how long ago that was. So, I was thinking about it, but I've been to Vegas a couple of times. It's never crazy about the city. I mean, I like New Orleans a little bit better than Vegas. New Orleans, you can walk the strip, you can have some drinks. Vegas, you cannot walk the strip, man. That's a long behind big strip. I'm pretty sure it's gotten bigger since I've been there. So yeah, shout out to that. DJ Dykes says, not money related. Had to ask, are those real books? Or no, these are not real books behind me. This is a green screen, ladies and gentlemen, behind me. So this is my office. I do have real books, but my real books are in my office, which is right behind this. But this is a green screen. I can make this thing in anything. Sometimes it's the Denver skyline, and sometimes it is a bookshelf. So no, these are not real books. Here we go. He said, God have mercy on all of us. Robert Kiyosaki warned the economy is the biggest bubble in history and urges investors to dump paper assets. Here are 3 real assets he likes instead. 2022 has been rough for most investors. Stocks, bonds, and even crypto plunged, but the worst could be yet to come, according to Rich Dad Poor Dad author. Hold on to your money. And he says, come to Hawaii. You want me to come? Man, I haven't been back to Hawaii. I might need to come back to Hawaii one day and visit. I still shoot my show out of Hawaii. So, shout out to Think Tech Hawaii. One of my shows are going to be coming out tomorrow that I shot in Hawaii. But, no, when I say to that whole dooms thing, shout out to Robert Kiyosaki. I just think we're in a recessionary period right now. A lot of us suffer from PTSD after watching the what is that? A lot of us suffer from PTSD from watching 2008 and the pandemic happen. I don't believe we're in a doomsday society. The only thing that scares me, the only thing I would really believe into that and get into that doomsday is if we went to war with China and lost. If we go to war with China and lose, all hell is breaking loose. Yes, we're going into a depression, deeper than a depression. That's the only thing that scares me economically wise. As long as we got the strongest military, we're going to keep on riding this little buggy with one little wheel. That's what I'm going to say. Jeff Bezos said you may want to rethink about buying new. Yeah. That's already have happened. Listen to Jake Jabs. Jake Jabs is the owner of American Furniture Company. I just ran a good bit of his interview. I'm going to be putting up his whole interview. He owns the largest furniture company here in the Colorado area that's doing $1 billion worth a year. And that's a big durable good. He's already down 5%. When you're seeing furniture companies are down, that's letting you know that we've been in a recession. Come on, man. We had this conversation on my last episode. My belief is we've already been in a recession now for about 6 months. And recessions are never recessions are never this predictable. Everybody's talking about the recession like it's an upcoming hurricane. This has never happened in the history of recession. Recessions and depressions and fallbacks have always came out like the black swan. Like we're just walking down the street and boom, COVID. That's how 2008, boom, housing market. 2020, boom, the bubble. 87, the flash crash, boom, they come out of the blue. 29, the Great Depression, it always comes out the blue. I've never seen so many people know about the upcoming recession like it's a hurricane. Everybody's like a meteorologist telling everybody, guys, get ready. Hurricane Ivy is coming. It's on the way. I have never seen a recession happen that way. A recession that makes bubbles and recession that burst at the most unopportune time, like Bitcoin. 2 years ago, when everybody looked at Bitcoin and was like, oh my God, it's a big government. Oh, look at it, it's exploded. And people didn't know that was the peak. People were talking about like, oh, hey, you ready for that recession? You better save your money for the recession. That's what meteorologists do when a hurricane comes. That has never studied. Out of everything I've studied and read, and I've talked to so many, that's why I like talking to old people, because old people lived through it. They went through World War II. Someone went through Vietnam. Someone went through so many things, and they will always tell you right before the market happens, right before a fall off of the market, nobody sees it coming. It always comes out the blue. Now everybody today is just talking about like, oh yeah, man, you ready for that recession? All you gonna do for that recession? I'm like, dude, everybody's talking about this thing like a hurricane. That didn't happen in 29. That didn't happen in 87. That didn't happen in 2020. That didn't, when the pandemic happened. That didn't happen in 2008 during the housing market. That didn't happen in the 2000 tech bubble. We never seen that happen before. They always come out the blue, something crazy. So, so he's saying recession by UBS, 61% of millionaires allocated up to 30% of their overall portfolio to exclusively assets. You have to be a landlord of Walmart. Yeah, now I can get into the private market, private debt market, and all that type of stuff like that too. But that's probably for another episode. He said, unfortunately, we may lose. We're not losing the newest frontier. So we're not losing in the newest frontier space. You're right. Yeah, exactly. That's how it got to happen. You walking down the street and all of a sudden, boom, a war breaks out. And then that's how the economy. But you know what? The beautiful thing about a war, which I hate to say, is that right now there's so much divisiveness in the economy right now. Not the economy, but in the country. You got white, black, lesbian, gay, LBGQ. You got so many things that's going on. And I'm Christ, I'm atheist. One thing the war does is it does unite people. I will say that. It does unite people. But yeah, y'all get ready to head up out of here. Here we go. Just one question about Bitcoin. Why are people exchanging actual money for fake money to be exchanged for real money? Because when an asset class is going up, this is why you have bubbles. When an asset class is going up, nobody cares about the fundamentals. If it's making money, nobody cares. People will go buy Chuck E. Cheese coins if it's making money. So that's why people are doing it. And why have money for war but can't feed our poor? You know how this goes. Come on. Come on now. You know how this goes. You know, we always got money for war. We always got money for missiles and stuff like that, right? Because right now, it's the biggest thing that it protects our economy is our ability to fight. When you got the biggest gun, you make the rules. It's like a drug deal. That's why we can have a deficit. That's why we can print as much money as we want to. That's why we can just stimulate the economy, print money and give it out, pay people back with fake dollars, do whatever we want to do because we got the biggest gun. If we did not have the biggest gun, we will dissipate as an economy. We will turn into Germany after World War II. But we got the biggest gun, so as long as we got the strongest Navy, Air Force, and stuff like that, we good. We good to go. So anyway, ladies and gentlemen, that's going to be my time for the late night show. Thank y'all for tuning in. For the people that catch the playback, join the conversation too. I look forward to seeing y'all comments in the morning, and I will see you guys and girls tomorrow. Appreciate y'all. It's late night over here in Denver. I know it's super late on the East Coast. Thank y'all for tuning in, and also out there in Hawaii. Thank y'all for tuning in. I know it's like 9 o'clock over there. So anyway, ladies and gentlemen, that's my time. Y'all already know my name is Prince Dykes. I am the Prince of Investing. Into the next video, podcast, cartoon, or whatever else crazy you see me doing around the globe. Go check out those books. Go donate to that book drive. Peace. Be safe. I'm out, and thank you.